If you look at the markets right now, you'll see retail investors reacting to a surge of global anxiety. Escalating naval tensions and oil shocks are currently dominating the headlines. These global disruptions are landing directly on the Philippine economy. Domestic inflation has recently spiked to 7.2%, hitting a 3-year high. That inflation is putting direct pressure on the local currency. War-driven risks have led to a drop in the peso, increasing the cost of imported goods and adding to market volatility. But making investment decisions based solely on these high-level macro headlines can be misleading. While the general sentiment is fearful, specific microeconomic performance data suggests a different reality is developing underneath the surface. To see that reality, we have to look past the crowd and focus on the localized performance of institutions like Metrobank. In the first quarter, Metrobank generated 12.6 billion pesos in net income. That represents a 2% increase year-over-year, despite the broader economic headwinds. This steady growth suggests that capital is still flowing into robust banking stocks, even as general market sentiment remains cautious. For investors, ignoring these specific bank earnings means missing the primary signal that explains where the actual profit is being generated in this economy. The engine behind that 12.6 billion peso profit is a specific 11.2% expansion in consumer lending. This chart visualizes how lending volume impacts the bottom line. An 11.2% growth in consumer loans pushed net interest income up by 13.6%, reaching 33.4 billion pesos. This resilience in domestic spending continues, despite inflation hitting a 3-year high. To support this volume, Metrobank's low-cost current and savings accounts grew by 8.4%, providing the bank with a stable base of funding for its lending activities. Essentially, a well-capitalized bank can generate profit from the same economic momentum that creates the inflation narratives scaring away the broader market. We also have to account for the rise in expenses. Operating costs grew by 9.8% during the quarter, reaching 21.1 billion pesos. This increase was driven primarily by transaction-related taxes and investments in new technology infrastructure. But the structural advantage of the bank's margins is clear. The 13.6% jump in interest income outpaces the 9.8% increase in costs, leaving a healthy surplus. This efficiency resulted in a cost-to-income ratio of 52.5%. Further shielding the balance sheet is a 5.1 billion peso income from fees and trusts, which grew by 11.8% and helped mitigate the impact of a volatile trading market. By maintaining wide interest margins, the bank insulates itself from both rising internal costs and external economic shocks. This leads us to what we call the Alpha Protocol, an investing mindset that prioritizes hard defensive data over emotional market reactions. To measure a bank's defensive strength, we look at non-performing loans, or NPL, which tracks the percentage of loans at risk of default. While the industry average NPL is 3.44%, Metrobank's ratio is nearly half that, at just 1.75%. Supporting this is an NPL cover of 137.1%, meaning the bank has set aside significantly more cash than needed to account for potential bad loans. Combining this level of asset quality with strong capitalization is what characterizes a heavyweight value stock during a period of economic stress. Macroeconomic panic is often just noise. Looking at the microeconomic signal, solid asset quality and healthy buffers, the path for smart money becomes much clearer. To keep your portfolio focused on the data that matters, subscribe for more Philippine peso VITs. Now I want to hear from you. Are you accumulating MBT right now to take advantage of these margins, or are you sitting on the sidelines? Let me know in the comments.